Hello and welcome to BloombergQuint. We're in conversation today with Dr. KV Subramanian, Chief Economic Advisor to the Government of India, on his way out soon, but here to help us understand his perspective on the economy and all that's going on. Sir, thanks so much for taking the time to speak to us here on BloombergQuint.
My pleasure, Ira.
Let me start, sir, with an understanding of how you're viewing the latest round of economic data, particularly the GDP numbers. I think the headline numbers are certainly showing what everyone anticipated, that the recovery continues, this is ongoing. I think there's still some lingering doubts, the strength of consumption, and whether demand conditions have actually sort of improved adequately, whether signs of stars are still there, particularly within that consumption segment. What's your reading?
So I think, a few things that are quite noteworthy. First, this is the fourth consecutive quarter of growth that India has had amidst a once-in-a-century pandemic. Few other countries have actually been able to record that. Second, with this quarter now, consistently, India will have, GDP that is higher than pre-pandemic levels. Because if you remember, the third and fourth quarter of last year, we had positive growth. And now, this quarter, after a 7.4% decline, the 8.4% increase means that we are actually, slightly above, pre-pandemic levels for second quarter. And going forward, that will continue. So I think that's the second important observation to make. A third observation, I think, is that, even though this has happened, of course, because of the base effect, that is not something that still, that should not make it noteworthy. Because what we have to understand very clearly is that, when the prediction, for the recovery was made, we had made it in September of 2020. Few people had actually believed it at that point in time. So it was not expected. We called that, clearly taking into account the fact that, the resilience of the economy. So I think if it was not expected a priori, a posteriori, then to say it was expected, I think displays a certain inconsistency, which I think should be avoided. We have to be consistent So I think it's what is not, appropriate is to cherry pick, on the one hand, not expecting it in September 2020, and now when it has actually, manifested, to say, oh, it is expected. I think that is something which we have to avoid if we have to do a rational assessment. I think the final two points I would make is on the, on the sectoral aspects. If we look at the manufacturing sector, clearly, it had been growing very well even before the pandemic. In my presentation following the GDP release, I actually showed as well, from 2015 to 19, that 5-year period. For the first time, India has actually recorded growth rates in manufacturing exports, and overall, merchandise exports itself higher than that of China. It's happened for the first time in a 5-year period. While that phenomenon was affected, temporarily by the pandemic, again that has accelerated. You must have seen the purchasing managers index, at a 10-month high, and the commentary with it actually that has been put up by IHS Markit is also quite optimistic. Second, I think service sector, while it has recovered, and actually there's been 2 quarters of double-digit growth in the service sector, but it is still below, pandemic levels, below pre-pandemic levels. So, that is something which actually also means that there is scope clearly for improvement there, for it to come back to, to pre-pandemic levels and go beyond. India, right now still continues to be a service sector dominated economy. What that will do is both on the production of services and the consumption that it will create in other sectors, when, you have basically earnings thereby happening in the service sector, will be something that will boost consumption as well. I would say the couple of things that we have to watch out for is, one, the new variant. I think the evidence is still coming in, where, whether it will be more virulent than the Delta variant. I think that's something which we have to watch out for. At the same time, I think the vaccination push that has happened very well now with more than 125 crore doses, I think doubling down on the second dose, I think, is very important, because even though this may be a little more or less, virulent than the Delta variant, average level of immunity that will be provided by immunization, I think, is something that one can't, take away from. So those are the two things that I would actually mention in terms of aspects that to watch out for.
So you don't fear a demand problem in the economy post, sort of the base effect driven ups and downs that we have seen. The argument there being that, the income, the wage impacts that that the lower income segments of the economy saw, and that is where the propensity to consume is higher, is going to then start playing out in years subsequent to this year. And if consumption demand doesn't pick up in a big way, that obviously, bears on private investment demand as well. That's one school of thought. What's your take?
Yeah, I did cover this, in the presentation. When people talk about scarring, right? The macroeconomic phenomenon that economists speak about is hysteresis. What I separately analyze the formal sector and the informal sector by taking into account the nature of production. Today's article in the Economic Times as well explains this. The fact that the formal sector has actually emerged clearly, stronger and healthier after the pandemic. One part of the policy was fortuitous, which is that the tax rate cut that we did in September of 2019, provided cushion to the formal sector. They were not basically as badly impacted, because their bottom lines, there was more cushion that came in. And hysteresis typically manifests when firms have to sell their assets, in order to take care of their obligations. And that happens for firms that actually rely on both capital and labor for production. The informal sector, on the other hand, actually typically relies far more on labor for production, less on capital. And because it relies less on capital, as a result, the obligations to the formal sector, that have to be made are lower. So that the need to sell assets to be able to take care of those obligations and therefore continue the business remains lower. And this, I think, has been seen as well. If you saw after the lockdown, induced actually contraction that happened in consumption, once the economy was opened up last year, you saw consumption pick up significantly. Even in the first quarter, if you looked at consumption, it grew at more than 20%. But what is important is that consumption grew despite some of the supply, related restrictions on consumption itself. The fact that many malls, bazaars, shopping establishments, etc., were closed, during that time. And so if you wanted to go and buy a shirt, or you wanted to buy a pair of shoes or whatever, you couldn't do that. And yet consumption grew. So I think that part is something that has to be kept in mind. I do think that the, informal sector has been impacted more. But for the reasons that I've explained, as the economy comes back, the sort of the memory of, or what economists call as, in the hysteresis going forward will be lower in the informal sector. And that is something that actually will help in India. Counterfactually, or in a what if scenario, if, for instance, the formal sector had been impacted far more, then you would have actually definitely had to worry about this, because that would have meant far more losses in the jobs in the formal sector. If you see, jobs have also come back better in the formal sector because hysteresis has not happened there. So I think, across the world, every, economy has been impacted for sure. But I think India, because of the nature of production in the informal sector and because the formal sector has done well, will be less impacted in terms of the hysteresis.
Sir, government spending obviously has been a big support on the capex side in particular. It's been a little difficult to understand, given that fiscal situation seems very comfortable going by the available numbers so far, as to why the government is, sorry to use the word, but scrimping on other spends, particularly on Manrega. It's just been very difficult to understand why we didn't add money to that scheme when it was very clear that demand had remained strong this year.
No, Manrega demand actually has gone down, Ira. If you notice,
down, but it's still above pre-pandemic levels. It is still above pre-pandemic levels. If you look at month-on-month comparisons, it's still higher. And the money is out. I mean, the entire pool of allocation to Manrega has been used up. Why would the government, when it has the fiscal space, not give money to that very important sort of social support?
Okay, so I think, first of all, Manrega, clearly there is a commitment to, how much ever work is demanded will be provided for. Number one. So I think let's get that out of the way. Now to your
counterpoint to that. Sorry to interrupt, but I think if you speak to people who are involved with the scheme, they'll always tell you that when money starts to run low, the work provided starts to go off. There are longer delays in payments. My question is actually just that when the fiscal space is available, what's the reluctance?
Okay, so I think that and that's a very important point. And this really, in fact, distinguishes India now during this crisis vis-a-vis in how India was following the global financial crisis. It's very important to understand this very clearly. If you see, let me first tell you the outcomes and then tell you what, why this is important. Look at countries like Turkey, Brazil, Mexico. All these countries are actually now experiencing close to 20% inflation. The United States has had an inflation print that is at a 30-year high. During the global financial crisis as well, India had inflation that was every month, in double digits for 18 months, with the high being 70%. Now, ask the question, why did that happen? It's textbook macroeconomics, which is if you only do the Keynesian prescription of actually just providing for revenue expenditure, you increase demand, and that then creates significant inflation. If on the one hand you've actually had inflation at 4.5%, and thereby being within range, and yet there are people basically who are talking about some commodities actually where prices have increased, but on average inflation has been at 4.5% CPI inflation. Think about what would have happened if you actually had far more demand. I think this is basic macroeconomics, right?
I get that, but I'm going to push back on this one. We are talking about large fiscal cash transfers in some of those economies. We are not talking about that here. We're talking about a scheme which at times of stress provides a little bit of support to the rural economy, which last year had been given a strong budget. This year, okay, you start with a lower budget, but as it becomes clearer that you may need, why is the government holding back? I mean, this is not, cash transfers to all of India, which is going to generate inflationary demand.
No, wait. I think, Ira, you understand economics, far better to actually make those kind of arguments. Let me be very clear. So see, first of all, I think when you have in-kind transfers, if you look at basically the Garib Kalyan Yojana, more than 800 million people have been given free food. And what happens actually, if you are not spending on food, then the money that is given will get spent on other things. Actually, it will have an impact on demand. It is fungible. Let's not forget that. And that is why I mentioned that, far more economics to actually ignore that aspect. Second, I think it is.
I'm talking about quantums. I'm talking about quantums. I'm not saying it won't impact demand, but that is the demand we need. We're not sending checks to all Indians who are going to be spending. I'm just questioning whether a little bit of budget to Manrega would be inflationary, or rather would it be supportive to demand in the economy when, there are concerns about some segments and income segments having that ability to spend.
I think again, Ira, look at the data. The rural economy actually, if you look at all the indicators, is not a problem. And that is why, again, I think you are barking at the wrong tree here. It is actually, if anything, it is on the urban side where there is an issue. And we've talked about this before, where to provide the demand stimulus, we have actually used the guarantees together with lending by microfinance institutions. Why has that been the case? Because the problem is on the urban side where and we've discussed this, that if you provide a loan with a credit guarantee, that actually leads to much more targeted intervention. So I think, let me be very clear, make it very clear that the problem is not on the rural side. Therefore, your question about Manrega is actually misplaced. Number one, the problem is on the urban side, which is why we actually did use the microfinance institutions with the credit guarantee, so that it goes to those that are genuinely distressed and not those that are actually not distressed. And here, let me use the example again. We've learned from previous mistakes. What happened after the global financial crisis? The two most important items of spending. And they were, 85,000 crores in the loan waiver scheme, which actually, I have a paper showing it. The CAG also has said it was actually shambolically implemented, and money just ended up being cornered by those that already had, enough with them. The second was pay commission recommendations. And as a result, what did you get? you had demand push. So you got a short spurt in GDP growth, but then monetary policy had to respond, because monetary policy, even without inflation targeting framework, they had to actually take care of inflation. So you had series of rate hikes. As a result, whatever demand push was given by fiscal policy, monetary policy undid that. And so when you think in a dynamic scenario, you have to take this into account. Real world is not static. So if you actually just give far more push to demand, you will have monetary policy not being supportive. Right now, because of the way India has done, and I think this is something that I must highlight, India has been different from the rest of the world, emerging countries as well, on both demand and supply side. And while we've done supply side, demand side, we've done three things primarily. Food, as I said, which is actually essentials, which none of the other countries have a public distribution system. We've given cash transfers, but to widows and women, as part of Jan Dhan accounts. And third, we've actually given loans with credit guarantees, which actually leads to much more, calibrated and well-directed spending. So we have to keep in mind that fiscal space entering the pandemic was much lower, so it had to be spent very prudently, which is what we have done. As a result, now India actually, with very good macro fundamentals, current account, fisc, and inflation and growth that actually is much higher, highest among emerging economies. So that tells you how policy has been clearly very, very prudent. Otherwise these outcomes are not accidents.
Okay, let me move on to a couple of other issues that I wanted to bring up. One, of course, is the issue of asset sales. This was a sort of seminal year in direction, in approach to that. Obviously, some of these take time. LIC, I know, is going on. Bank privatization perhaps would be take a little longer than anticipated, which is okay. But I just want to understand whether there's now clarity on the approach towards this. Is this going to be a piecemeal, one or two banks, or is there a broader thinking that's now settled in the government's head as to approaching privatization with a goal or a roadmap?
Yeah, I think, I would certainly say, with confidence, it's the latter, because if you look at the first announcement, Atmanirbhar Bharat 1, one of the most important announcements there was the enterprise policy focused on the private sector, which actually said that except for 4 or 5 strategic sectors where there will be 4 or 5 state-owned enterprises, so all in all, maybe 35, 40, rest of them will be privatized, either privatized or will be closed if they're actually unviable enterprises. So the privatization agenda, including those of the public sector banks, that actually has is emerging from that particular policy, a very important policy push. In some sense, I look at that as, India's industrial policy sort of coming full circle after the first industrial policy gave the commanding heights of the economy to the public sector. Now, with the recognition on wealth creation and ethical wealth creation and the role of private sector in it, clearly, this is coming from that vision. It's an articulation of that vision. It's not a sporadic thing, and therefore taken to its logical conclusion, which will take some time. It'll happen. I think you will have a far more efficient production side of the economy with, both incentives and information working for the economy rather than against the economy, which is what happens, when you actually had the following of the first industrial policy, and thereby just, letting public sector do things that should not be done by the government. So in some sense now, this is, government focusing on doing what it should do and letting go of what it should not be doing.
Bank privatization in particular, is this just going to be a two-bank kind of policy, the 2 banks that the finance minister had indicated in the budget, or is this going to be a wider repeal which will allow for steady privatization of banking?
That's what I actually was saying, that, as banking is one of the strategic sectors. So, when this policy, the enterprise policy, is taken to its logical conclusion, you will have about 4 or 5, public sector banks. Rest of them will be privatized, because, the case for that has been made compellingly, both through the in the 2020 economic survey, in the chapter on privatization and the chapter on banking itself, clearly that, you need efficiency gains. I think the other point which I will mention is that, I was looking at some data which actually is very telling in terms of, in terms of the impact on GDP per capita. So what we were doing was we plotted the private credit to GDP ratio for India and a few other countries from 1960 to 2020, a 6-decade period, and then plotted the GDP per capita over the same period. It's very interesting. If you do that for India vis-a-vis Malaysia, India vis-a-vis South Korea, India vis-a-vis United Kingdom, India vis-a-vis Canada, you see that basically there is a mirror image of what happens on the private credit to GDP ratio, same mirror image on the on GDP per capita as well. And none of the other macros, which is your savings, investment, imports, exports, government spending, none of that actually seems to have that mirror image with GDP per capita. The inference therefore being that over a 6-decade period, we basically have really lagged behind in credit creation and thereby creation of money in the economy and therefore availing of investment opportunities, which has impacted, growth compared to these economies. So I think the financial sector really needs to actually be strengthened by following up on these privatization, and that's the vision that is being articulated here.
But if the government holds on to 26%, you see sort of enough people wanting to come into these banks?
So see, those details actually, will be worked out, and legislative change is something that is, being done so that the process can be enabled. I think even with with less than 25% stake, maybe 24.99% stake, that should be definitely possible because the governance, changes that will come about as a result will be adequate.
Going to the Companies Act, sorry, just to add this thing, will they go out of the Bank Nationalization Acts and into the Companies Act?
So I think that's a good question. That see, the banks today, public sector banks, are not companies in the because they all actually derive their existence from the Bank Nationalization Act, and so that is something which actually has been thought about. Either the change could be made in the Bank Nationalization Act itself. We have to remember that the Bank Nationalization Act was actually framed at a time when the government was going to own 100% of the of the banks. Now there were changes that were made when these banks listed, but now with privatization the changes automatically will have to be made. For instance, because the Bank Nationalization Act was framed with 100% government ownership, even the sort of constitution of boards was hard-coded, like certain kinds of directors, etc. In contrast, if you take Companies Act, actually it gives important guidelines for percentage of independent directors. So the preferable thing would be to actually let these entities derive their existence from the Companies Act and convert them into companies. I think that would be something that would be the optimal way to go about it.
Okay. A couple of other questions. Just one is on GST. I think you've spoken about the chatter around rate rationalization. Can you give us a sense of how quickly you think we can move in that direction? And again, one would probably have to be careful that there isn't sort of an effective increase in in indirect tax rates, because that probably not the right time for that, economically speaking.
So this is this aspect is being considered very, very closely in the GOM. What you have to understand, Ira, and viewers also have to understand, is that the GST Council is a federal structure, and really a federal structure. Having sat in those meetings and observed, there, I think it is a wonderful reflection of the federalism with all kinds of viewpoints, both those that are economically optimal and those that are may not be sometimes. I think they do come about, which is what happens in a democracy, in a federal structure. But I think the GOM is actually looking at all these aspects, and has been tasked with coming back with specific suggestions on the on rate rationalization, especially on there are some inversion in the duty structures, which actually is inefficient, and that needs to be tackled. Not only that, also the slabs also need to be thought about. I think to bring the GST in, it was okay to start with a 5-slab structure, but I think right now this may be the opportune moment to try and possibly rationalize those slabs and thereby bring efficiencies as well.
But in a way that effective tax rates don't go up, indirect tax rates, because the economy probably doesn't need that right now.
No, I think that's something which actually you have to keep in mind, that when GST was brought in, the revenue neutral rate that was recommended by by my predecessor was actually was about 2 to 3 percentage points higher than what actually came about, eventually. And that is something which, therefore the GST Council will have to consider as well. Because on the one hand, you were asking me about, more revenue spending. On the other hand, money does not. Money does not grow on trees.
The first 7 months of the year is the lowest in a decade, apparently, or something like that.
No, but money does not grow on trees. We all understand that very well, right? So you actually, I think that oftentimes there is this tendency to basically, have the cake and eat it too. That only happens in theory, doesn't happen in reality.
Okay, my last question to you, tough one, but nevertheless. So, we've seen what happened with the farm laws. The labor changes that were being proposed also have been delayed in implementation across all states. I think the bigger thing, and this is the point that was made by Yamini Iyer in a edit report for BloombergQuint, that perhaps we need a better structure for factor market reform at this stage, given that so many of them, fall between center states. Do you think these are going to be tough ones, tougher than what we had anticipated, because we haven't really managed to push through some of what we've tried on the labor side and on the agriculture side?
See, I would be a little, more careful in extrapolating, what happens in agriculture to the rest of the sectors. I've written about this, that in a democracy, reforms always involve the political economy. And I think agriculture, not only in India, but in the rest of the world as well, generates far more emotion than other sectors. For instance, a few months back last year, when there were a lot of tweets being done about the farm bill, you had actually farmers in Germany who had blocked highways with their tractors, for some reforms that were being brought up in agriculture. Similarly, farmers in France also have done that. So I think overall agriculture is something that generates far more emotion in a democracy than other sectors. The reason that is important is, therefore, you have to be a little careful in extrapolating what happens in agriculture, onto other sectors. The other point which we have to, really take into account is that it, took an agitation that was the, of a magnitude that has been seen for the first time in at least, close to 50 years. The last time an agitation like that happened when, you and I would have been in our nappies when George Fernandez, led the Rail Roko agitation. So I think that is also something that has to be kept in mind. We have to be very careful in extrapolating some of these. I do not think that the other reforms, will be as impacted as it is the case with agriculture. I think the factor market reforms, not just labor. When we look at factor market reforms, actually, especially if you take things from the manufacturing push, right? We've seen how logistics costs have gone down. I actually showed a bunch of data, in my presser. Similarly, power costs have gone down as well. These are important factor inputs into manufacturing. You've had the change in the MSME definitions, and because the scale at which a firm operates is also a very important factor, factor input, because it affects total factor productivity. So those all have been done as well to reap efficiency. We were talking about privatization, and that is also something that affects total factor productivity, because privatization and thereby production in areas where there are no market failures. When that happens in the private sector, you actually have efficiency gains as well, and those are being accelerated. So I think and the labor reforms have been clearly passed by Parliament, and I must mention in tabling that bill, the Honorable Labour Minister had referred to the evidence in the economic survey as well. So clearly, I think the fact that these are required is something that is felt by the polity, and therefore I remain optimistic.
Okay, sorry, I have one last question. I promised last. This is the absolute last, out of left field. So you've been seeing this debate going on around cryptocurrencies. The RBI has raised fundamental issues, not about trading, etc., but about macro stability, financial stability. As somebody who understands money very well, do you share some of these concerns?
So, I think the Honorable Finance Minister has already, made a statement on this. So I will not add more to that, but I will just conceptually clarify the way this has to be thought about. I think there are 2 or 3 important points here. First, the difference between cryptocurrency as an asset versus cryptocurrency as a currency itself. I think that's something that has to be kept in mind. Secondly, when we think about cryptocurrency as an asset, the fact that it actually, so there are arguments made that, blockchain, which is what underlies cryptocurrency, and that innovation is something that is important. I think that blockchains have very much applicability in the real sector, and they have been functioning, without cryptocurrency gaining, even when cryptocurrency hadn't gained the kind of traction that it had. So I think it is important, therefore, to not sort of go into this mode that cryptocurrency is a messiah for all ills in the which is not the case. The third point that we have to actually understand is that any financial innovation, and I say this as a financial economist, any financial innovation that is a zero-sum game, in other words, there are no positive externalities for the real sector. You have to be very careful about that. So, for the benefit of viewers, let me give this example. Suppose tomorrow we decide, you and I, sit all day and play cards. You will make some money, I may lose some money. But between the two of us, money has just changed hands. It still continues to be zero sum. We've not done any real sector activity. There's been no addition to real sector output, right? And that is what happens with zero sum games. Actually, when real sector activity, there is no addition to real sector activity. I think that is something that has to be treaded on very carefully. So these are some important conceptual aspects. Last point, which is even from an asset perspective, the fact that cryptocurrency doesn't have any underlying, right, and therefore far more volatility in the prices, and typically a consumer or an investor would actually want to invest in an asset wanting some stability in the price. If you look at gold as an asset, right, the price does not move as volatile, in as volatile a manner as it does for cryptocurrency. So these are important aspects that we must keep in mind. So there are two sets of constituents here, both on the extreme. One who say basically that, oh, cryptocurrency is a messiah. I have many students of mine who actually also try to convince me about it. But I think I've laid out the arguments on that. And there are others who actually say that there is no value. I think the truth is clearly somewhere in between.
All right, I'll leave it at that. So thank you so much for all your time and taking all of our questions patiently. Thanks so much for joining us.
My pleasure.